overall, yes, the consumer has definitely taken a bit of a hit from the fuel price hike that the government had to implement at the start of September, and that's going to keep your inflation numbers relatively high, at least into the towards the end of the year. But overall, what we are expecting is that inflation will probably average about 4.2% this year, but it comes down probably a little bit more into next year to 3.9% on average. And one of the reasons is that as we've been looking at the drivers of inflation in recent core CPI prints, what we have found is that the momentum in terms of core inflation, in terms of food prices, those have generally actually been easing off. And I would say that while we could expect inflation to remain relatively high going forward in the next few months, I do think that as we get into next year, we will see some greater moderation. Again, because that sequential momentum seems to be fading out a little bit in terms of cost pressures. And so overall, we do think that ultimately the consumer will remain relatively supported. The government so far, has held off from raising fuel prices even further, and coming out with the momentum of the recovery coming out of COVID, dwindling as that may be, that should continue to support fairly resilient growth next year.
Brian, given the global headwinds, where does this put the fiscal balance, the current account, and broadly balance of payments, and are they in a relatively stronger position compared to previous bouts of volatility and turbulence that have affected deficit countries and emerging markets vis-à-vis 2013? And ultimately, where does that put Indonesia's currency, rupiah?
So I would say that when we look at the recent numbers in terms of the GDP, what we did see, like I said, was that we found that the growth has become increasingly import intensive. The import intensivity of the number probably reflects the rise in the investment growth that I was mentioning earlier. That tends to be quite import heavy. And if that's the case, together with the drop in commodity prices, that will very likely lead to a deterioration of the trade surplus, the trade balance, and the current account balance into next year. The question, though, is how bad does it get? And, we're looking at numbers of about maybe 1 to 1.5% of GDP in terms of where the current account deficit might turn out to be into next year. That's nowhere close to what it used to be, in earlier episodes of stress for Indonesia. And we think that ultimately Indonesia is in a much stronger position than it has been in previous decades. Overall, that should continue to bode well for the economy, but ultimately, it will pressure the currency as well.